So, you've heard about indexed universal life insurance? Let's talk. It's a type of permanent life insurance designed to last your whole life, unlike term insurance. IUL combines a death benefit with a cash value component linked to a stock market index like the S&P 500. Sounds fancy, right? But if it sounds too good to be true, it usually is. These policies are marketed as hybrids, offering life insurance protection and investment opportunities. But when something tries to do too many jobs, it often doesn't do any of them well. We need to look at the fine print, fees, and real-world performance. You work too hard for your money to throw it at something you don't fully understand. Knowledge is power, especially with your finances. Let's get smart about indexed universal life insurance and see if it holds up under scrutiny. Don't let a slick sales pitch derail your journey to financial peace. Let's dive in. Breaking down IUL, the promises and the premiums. The cash value in an IUL policy is linked to a stock market index, not directly invested. The insurance company uses a formula to determine interest credited to your cash value. Key terms: participation rate and cap rate. Participation rate is the percentage of the index's gain you get credited. Cap rate is the maximum interest your policy can earn. Flexible premiums sound great, but can be a trap if not managed well. Underfunding the policy can cause it to lapse. The death benefit is flexible, but remember, life insurance's core purpose is to replace your income for loved ones. It's not meant to be a speculative investment vehicle. Keep it simple. Understand the limitations and conditions on your growth. Be aware of the fees and charges that can eat into your returns. Let's keep going. The advantages: they tout growth, flexibility, and protection. IUL offers tax-deferred growth, but are the net returns worth it after fees and limitations? Salespeople show glossy illustrations of potential returns, but cap rates and participation rates limit gains. IUL policies come with internal costs that can significantly eat into returns. Flexibility in premium payments and death benefit sounds attractive, but requires financial discipline. Reducing premiums too much can cause the policy to implode. It's not a set-it-and-forget-it product. Protection against stock market downturns comes at a cost. Lower cap rates and participation rates limit potential gains. You're trading potential growth for protection. Often, it's not a worthwhile trade compared to other strategies. Understand the trade-offs before committing. Let's move on. Section 4. Real people, real policies, examining IUL scenarios. Think about a young couple, Sarah and Tom, with kids and a mortgage. An agent might pitch them an IUL for protection and future growth. Are they better off with an expensive IUL or term life insurance and investing the difference? Fees and expenses in IUL policies can be massive, especially in the first 10 to 15 years. A large portion of your premium goes to sales commissions and administrative charges. Only a fraction goes into the cash value component. Slick illustrations might use optimistic assumptions. Consider someone like Bob nearing retirement. An agent might present IUL as a safe growth option. But Bob has a shorter time horizon for compounding. Complexity of IUL policies is a significant problem. Simplicity and transparency win in the long run. Section 5. My 2 cents: is IUL a smart move for your money? Salespeople tout potential cash value growth, downside protection, and flexibility. But there are significant catches: caps on earnings, participation rates, and fees. My advice: keep insurance and investments separate. Buy level term life insurance, 10 to 12 times your annual income. Term life is cheap, simple, and does one job perfectly. Invest the money saved in good growth stock mutual funds. Tax-free policy loans are touted as a benefit, but they come with risks. If the policy lapses with a loan outstanding, it can become taxable income. IUL is often an overly complex and expensive product. It rarely outperforms a straightforward strategy of term life insurance and investing the difference. Don't fall for the hype. Build real wealth by getting out of debt, building an emergency fund, and investing simply. That's how you achieve financial peace.